Do you want to know how to beat the S&P 500 index? Well, don't we all? And today we're going to be talking all about the indexes in our very first series of the Index Mastery Month. And joining us today is Mr. Breakout himself, Tomas Nesnidal. Welcome.
Thank you very much, Andrew. Hi, guys. Welcome to the Index Mastery Month.
That's
and I'm super excited about this one. I don't know how about you guys, but I love trading indexes. Indexes were the very first markets I've ever traded. So I have a big sentimental connection to indexes. And it's been always with me, indexes. And I've been enjoying trading indexes for a long, long time. So I have a lot to share with you.
Yeah, that's right. And so I think as well, indexes are probably the most popular market to trade. So hopefully what you're going to share today, well, it will be valuable, but hopefully it's going to be valuable for the most amount of people we can help. So I'm really looking forward to this very first episode of Index Mastery Month. I struggled to say that before, but I think I've got it now. So where do we get started, Thomas? Where do we start?
Right. So when it comes to index trading, a lot of people think in terms of index investment. And, there's always a lot of questions, how much index investing makes, what is the index S&P performance, and kind of index, especially S&P, is a benchmark for, let's say, everything. And a lot of people and traders and investors, they always compare their own performance to S&P, and that's kind of a benchmark. And there's always a lot of interest. How can we beat this benchmark? How can we beat S&P index? And tonight, wherever you are, I'm going to show you that it's really, really simple. Like it's stupid simple. I'll show you how to do it in less than 5 minutes.
No way. Is that even possible?
Yeah.
Less than 5 minutes? Okay.
Yes.
Well, I guess before you show us how to do that, we need to know what the benchmark is, right? We need to know, what are we aiming for? What are we trying to beat?
Yes. Okay, so we're going to talk about how to beat the S&P 500 index with a 5-minute trading strategy, which maybe will be even less than 5 minutes. So as you said, let's have a look what we're competing with.
Yep.
And this is a pretty good article, which pretty much says that the performance of the S&P is, now I cannot see it properly, one number is for a decade on average. I think it's
10.7.
14.7, and long term, since something 57, it's on average about 11% per year. So I think it's safe if we say that the expectation average is maybe about 12%. But the question is, what is the cost of that percent as well, right? Because especially this year, but many years in the past, we saw big index drawdowns. I think this year we're minus 25% or something like that. I would have to double check. I haven't looked for about 2 weeks. So that's a pretty steep drawdown. And with E-mini S&P strategy, with E-mini S&P market, we can really create a strategy to compete with that. And the reason we can do it, and we can do it pretty simply and quickly, is because of something which I totally love about indexes. And I think this is the biggest advantage of indexes. Well, some other markets do have this advantage as well, but indexes have it the most. And it's also something we will be coming back to during this index month, November. And the thing is that a lot of indexes, or the indexes as a whole group, they have pretty strong, I call them tendencies. So that's the beauty of index trading, that there are some specific things which kind of create a directional bias by itself. And these things they do, from my research and experience, they only apply to indexes, but they're really timeless and powerful. And to beat the S&P 500, all we need to do is really deploy these few principles, which are so obvious in index markets. And that's what we will do tonight.
Yes, and in the coming episodes of Index Mastery Month as well, aren't we?
Yes.
Exactly. So I'm just going to fire up the slides again, and just one moment. Here we go. So what are we talking about here, Thomas?
Right.
Can you see?
Can we go one slide back? Is this the first slide?
Did I jump ahead in all my
Oh,
excitement?
no, you didn't. You
First
didn't. Yeah. Okay. Okay. So first thing I wanted to say, okay, so we're talking about, of course, the study is talking about big S&P index, and we're not going to work exactly with big S&P, but we're going to work with E-mini S&P. The reason why I chosen E-mini S&P is because it's a very popular market to trade, which I love trading as well. And there's a pretty good bias, strong long-term bias in S&P, and we will talk more about these biases in future episodes. So this is kind of like a sneak peek from one of the upcoming episodes. But S&P is still one of the best and most long biased indices out there. So in this table, we can see the overall, we can see the average trade, what it would be, what it would look like the last 3 years if we would trade every day, if we would buy on open and sell on close of the day, regular trading hours. If we do this for long and for short. And this is quite surprising, right? Because what we can see, and again, I'll get back to it later in one of the episodes, but what we can see that, first of all, it's not so obvious that we have a long-term bias in indexes as it's usually said, because, for example, we now have a short bias in EMD and RTY, which again is surprising because we're talking about the last 3 years. And I know we're in a bear trend right now. So if we would just take into consideration the last 6 months, that would be a different story. But we're talking about last 3 years. And something is changing within the index category because obviously it's not so obvious anymore that indexes as a whole have a strong long bias. It is not the case anymore. Again, I'll get back to it in one of the episodes, but that doesn't apply anymore. But the truth also is that there is one market, and you can do this 3 years back and 15 years back as well, which still keeps the long bias quite strongly, and that's the S&P and E-mini S&P. So of course recently we had a very strong long bias in Nasdaq, which was driven by all the tech. I don't know if it's bubble or it's not, but the whole tech sentiment. So right now, this was the last 3 years the strongest rising uptrending market, and we also had YM. But the truth is that the most stable one is E-mini S&P, and all the researches I did, proven that really E-mini S&P is the market which seems to be most stable in their tendencies, including the tendency of the long bias. So if we want to think about beating the big S&P or S&P indices in general, I believe that E-mini S&P is a pretty good choice because the long bias itself, it's already a bias which will help us to do that. And it's a good base how to beat that among other indices. Does it make sense?
Yeah, absolutely. So can you, just for this study, can you explain, it says RTH up there, which I assume means regular trading hours. Can you explain a little bit more about how you got the numbers for this study?
Yes. So again, regular trading hours, what I basically did, I simulated what happens if I buy or sell every day at 9:30 a.m., which is when the market opens, or is it 8:30? It depends if we talk about New York or Chicago. It's 8:30 New York, 9:30 Chicago, and the market closes 3:15 p.m. And what I did, I basically simulated when I buy on this opening and sell on this closing, or vice versa, and what would be the average trade during the last 3 years.
Right.
For every, right? Yeah, trading every single day.
Yep. And then so for the short side, you obviously went short at the start of the regular trading hours, the regular session, and then closed it at the
Yes,
end of the day. So you're getting an opposite.
exactly.
Yep. Okay. Well, that makes sense. So how can we, I mean, you've kind of explained a little bit about what this means, but how can we actually use
Right.
this, right?
Exactly. Now, and this almost sounds unreal, but I'm going to show you 4 simple tendencies which go back into history, and you will see them again. And I believe these are the only tendencies that if you deploy alone, you can beat the benchmark. So let's talk about these tendencies, because these are pretty interesting. And again, very stable and very prevalent. Prevalent? Is this the right English word?
Prevalent.
Prevalent.
Yes.
Prevalent in index category. So, can we get the slide?
We sure can.
Again. So there are 4 things that I would consider crucial and prevalent regarding index trading in general. And I will start from the second point. So first of all, and this to me, this is still kind of mind-blowing. If you so the entire industry, especially the banking industry and the so-called benchmarking industry or analyst industry, they use between 2 or 3 moving averages to determine whether there is a bear trend or bull trend. And kind of the key moving average they use is moving average 200. So sometimes I hear 204, sometimes 200. Overall, doesn't matter. But in the entire industry, the 200 moving average is kind of like a standard deciding whether we have a bear trend or a bull trend. Now, go figure, but from a lot of my testing, this moving average is pretty much on the spot. It's pretty much very valid. And I think the whole idea of this 200 got so it's like it got so embedded into index trading culture that I believe it created a bias by itself. So, and again, I did a lot of studies on that, only using two strong biases. That means the long bias in S&P, which is long term, and moving average 200 already is already combining 2 pretty good biases, good strong tendencies that alone can already give you kind of an edge. So that's the first rule. The second rule is that indexes are, and actually here is the number 1, indexes are absolutely phenomenal for breakout trading. Whoever studied my Mr. Breakout's formula, which again you can all get in the Breakout Trading Revolution book, then this formula works like a magic in indexes. And indexes were the very first markets I deployed the Mr. Breakout's formula to. So that's another bias, like strong tendency. Like indexes are super responsive to breakouts. Third one, it's not so obvious anymore, but came out of a lot of my research as well. And I don't know when it was, but recently I revealed that I have 2 favorite indicators. And actually, I will talk about it in this index mastery month as well. But I have 2 favorite indicators. The first one is ATR, average true range. I'll talk about it this month as well. And my second favorite is ADX, average directional index. And it's a trend indicator which pretty much helps you to recognize when we have a strong versus weak trend. And that was another research that I did that confirmed that ADX works like a magic very reliably on daily index data. It doesn't even matter which index you pick. Like the ADX filter, it's like it's given. It's another extremely strong tendency. So that's the third one. And the fourth one is closing at the end of the week. And again, this is something I'll talk about this month as well. But basically, if you only buy on Monday and close on Friday, that alone creates another tendency. So we have 4 very, very strong tendencies. We know breakout works. We know there's a built-in bias in 200 moving average. We know ADX it works like a magic, and it's very universal for index trading. And we know that exit at the end of the week are extremely powerful. So all we need to do to beat the index is pretty much combine these 4 together. And I'm going to show you how in TradeStation directly in a code.
Wow.
Is that neat or what?
That's very neat. So when you say you're talking about you've done these studies and these are the types of things you've found, are you referencing that 3-year study that we just showed a few minutes ago, or are you talking about it over a longer period as well?
I did a longer as well, and I usually do longer and shorter. The reason I do longer and shorter is that longer gives you a long-term overview, but shorter term, like 3 years, needs to confirm that. We do not confirm that. We might be just, overfitting, and also we need to see whether the tendency is fading or if it's still there. So I always cross-check long-term and short-term.
Yeah, I think because that was going to be my second question. What about fading tendency? Sometimes, especially with types of studies like Day of the Week and things like that, they phase in and out, right? They shift over time and they come back and they change. And so I just wonder how that would direct into the research that you're talking about. So it's good to hear that you're testing over multiple periods.
Yes, so definitely some tendencies do fade.
Yep.
Okay, what I would like to try to do is to, and I hope it will work well, to share my remote desktop. I never did it here in the Zoom. Okay, unable to share the screen. Please update system permission. Oh, Apple. Uh-oh. That's annoying. We can keep going. I'll do it. It will let me just do this, whatever is the reason. I'll do it quickly. So,
okay, while that's happening, I see we've got a nice group attending today, a nice audience. I'm wondering who here trades indexes? Well, actually, maybe the question should be, what's your favorite index to trade? Because I think a lot of people just trade indexes by default. So what is it? Is it the S&P 500, NASDAQ? I know a lot of people, their favorite index is NASDAQ because it moves quite well. There's a lot of volatility, a lot of opportunity, but it can also bite you a little bit in the butt. So what's your favorite index? Share in the notes. Oh, sorry, not in the notes. Share in the chat. Let us know while Tomas updates his permissions, because I think we really want to see what he's got in TradeStation to share with us. Okay, we've got some coming in here. G'day, Bill. How you doing? Favorite index, NASDAQ. Why is that, Bill? Is that because of the volatility? Is it easy to trade and difficult to trade? Okay, Jace. G'day, Jace. How you doing? Yes. E-mini micros from Nate. Absolutely. Stephen's another NASDAQ one. G'day, Stephen. Nate says you can position size quickly with the micros. Absolutely. Micros are very handy to get very small incremental position sizes. So I can understand why they're picking up in popularity. The micros are really becoming very popular. So so we've got a couple of NASDAQs, a couple of E-minis. Bill says, Bill likes the volatility bigger. Sorry, let me read that properly. NQ, volatility is bigger movement per day. Yeah. So Stephen says has been moving cleaner, higher highs and lower lows. And Stephen said NASDAQ as well. Okay. And Jace, I trade cycles, trend, and reversion with ES. So it sounds like you got quite a few approaches covered there. Thomas is back. And I think we can see
sorry about that. Yeah. Can you see my TradeStation now? Oh, you see two small windows.
Remote desktop. Yeah. So if you select the one we need.
Yes.
And then.
Okay. That's weird. You see something.
Here we go.
We're almost there, guys.
We're so close. Come on,
Sorry.
Thomas.
So close. Yeah, we'll do it. Thank you for being so patient, guys. We're almost there. It will be worth it, believe me. So
now you can see the joys of doing live shows. Sometimes you have these technical difficulties, and you just got to go with it. So
we have it.
Looks like we have it. All right, no pressure, Thomas, but this better be worth it.
Yeah. Okay, thank you, guys. You're awesome. That you've been patient. This was totally unexpected. It is the Apple thing. I usually normally use this PC, but anyway. So have a look, right? So we have. Can you let me?
I'm going to try and
this
make
is better, isn't
the
it?
screen a bit bigger. Yes.
Yeah.
Okay, we can see.
Okay. So now, okay. So we said we have. Let's do it. So we said we have. Or let's start here. So first of all, we will use a E-mini S&P, as I said, E-mini S&P chart, 45 minutes. You can also use 30 or 60, it doesn't matter that much. The most important thing is that, first of all, I'm using data since 2007. The reason I'm using data for 2007, because this is where we start with reliable data. Anything before 2007 is not really reliable, because around 2004, 5, 6, exchanges started to push electronic trading, overnight sessions, and it's quite messy. And the data before 2007 are not really reliable for reliable testing. So I start with the 2007, the earliest, never before. The more important thing is that I added these daily data. So we will create a simple strategy, breakout strategy on 45 minutes data, but we will need a daily data, a second data, because we need second data to really utilize these two tendencies I was talking about, which is the moving average and the ADX. So basically what we need, so first of all, what we need is, we need one condition, which is super simple, which is close of data 2 is bigger. I'm trying to find bigger on this keyboard, is higher. Let me switch to English keyboard. Is higher than average close 200, again, of data 2. Okay, everybody clear about this one, what we're doing here? So we're just deploying the first tendency. All clear?
Yeah, you got a typo in average there as well.
Yeah, thank you.
Isn't it the case when everyone watches you typing, you turn into a terrible typist?
Exactly.
I'm the same. Yeah.
Now we know we have second strong tendency, and again, we do not even bother to optimize this moving average. Like, there's no point. The whole industry uses 200. So that's the built-in bias. We don't want to optimize anything here. We just want to use a built-in bias. This is industry-like built-in bias. The second tendency is ADX, the average directional index. Now, doesn't really matter that much which period you pick. So let me pick, since we're on daily data, let's pick 5, like 1 week. We have five trading days. And now, if you study the ADX a little bit, then the whole idea is that certain level, anything above certain level, means that there's a strength in the trend, which is what you want. Some material recommends value 20, some 25, some 30. You need to experiment with this a little bit. From my experience, doesn't really make a huge difference, although it can make a difference. So we use ADX bigger than 25. One important thing is that ADX, you can use it on both the main data and the second, the daily data. It works very well on both of them. So it doesn't really matter. Like both of them, it's very universal. Or you can combine. You can use on daily data plus on the underlying data, then of course you need to be careful because you will filter out a lot of trades. So let's just keep it as it is right now. So we need two simple conditions, ADX. We can play with that. Let's just type in, see what happens, and then we can play with this a little bit. And now we need a simple entry condition, breakout condition. So breakout condition is usually defined as and again, if you don't understand breakout trading, use my breakout trading formula here on the link, the breakout-trading-revolution.com, where I describe it very, very easily. But what we usually do, we take some point of initiation. My favorite is on indexes is yesterday's close, very universal. I use it very, very often because it works pretty well. And then the breakout will be defined as point of initiation plus some space. So let's use average true range for the calculation of the average true range. Let's use average true range, trying to type here 20, and let's use 2 times average true range. Again, that's something you might need to optimize a little bit, but two times average strength, it's average true range. It's a pretty good default value. So now we define 3 of the 4 tendencies. So we have the moving average, that's the basic one. We have ADX. Again, later on we will play with it a little bit more. Then we have this defined breakout level, which is 2 times average true range added to yesterday's close. Again, if you don't understand breakout trading, study my breakout formula in the Breakout Trading Revolution book. It's all described there in details. Now, the last tendency we have is exit. But before we create exit, let's create the actual entry. So the actual entry is if condition 1 and condition 2, I think I have another typo there. No, I don't. If condition 1 and condition 2, then buy next bar at value 1 stop, which is a breakout. It's a simple breakout order. And then once we are in market, we can set the exit at the end of the week. So a day of week is Friday, which is 5. Then set exit on close. So now we defined all these in a simple code. We define these 4 tendencies. Is it all clear? Any questions?
No questions. No, we've got a couple of comments in the chat. Jace has got his TradeStation open too, so I assume Jace is following along, which is nice.
Oh, great, cool.
Yeah, and one made a comment. Maybe one missed the first part. The close of the average is data 2 as well. So just to clarify, we're using data 2 to determine the
for the moving average. Yes.
Yeah.
That's the most important one. This must be on the daily data because that's the industry built-in bias. So that must be. The ADX works on both. Let's start with main, and then we can switch it, and let's see what happens if we swap it to daily, because it works very well on both. Now we also, it's better we set some stop loss. Otherwise, we will have huge drawdowns. Stop loss usually needs to be done carefully with some maximum adverse excursion analysis or some optimization. But in general, let's say $1,000 US, it's a good default stop loss. This is like a protective stop loss, just for protection on E-mini S&P. Maybe nowadays could be a little bit higher, but about 1,000, it's a rounded number. We can use that. So what all we do, again, we're deploying 4 known tendencies we know that do work in E-mini S&P in markets. Actually, I have a typo here. This is buy. So let's verify. Okay, something's not right here. Buy next bar. Okay, typo. Okay, verified. So this is called BTA S&P 500 strategy. Now I've already inserted this, pre-inserted it here, so we don't need to bother with it now. So we have the strategy now. It's the same one. You can see BTA S&P 500 strategy, like completely the same one. I just did it, put it there in advance to save some time. And now let's see what happens. Like what happens if these tendencies are strong enough to really beat the index. What do you think?
Well, it's not terrible. What does everyone think? Let us know in the chat. I mean, it's heading in the right direction, isn't it, Thomas? We've got an upward sloping line.
Yeah. So first of all, don't forget we're in a 25% drawdown with the actual index this year. So this definitely is not 25%. So we're already beating index here because S&P is year to date about minus 25%. But now we know that the index delivers, an index alone delivers on average 12%. So now we have from 2007 to 2025. So we're talking about 15 years. So we should do about 160, 170% return probably. This is a very, very easy, very simple calculation. This strategy on one contract would do approximately $80,000, a little bit below, and the drawdown, and again, we have not optimized anything. This was just like very quick sketch, would be about 15. So we would need at least 20,000 to trade this strategy. That would be the minimum. So we would be covered with the margin. But with 20,000, we would make almost 80,000. So we're talking about 400. Now we need to include of course, some cost, but the cost will not eat that much, the transaction cost, because the average rate is really high, it's about 118. So even after cost, we should sit on 250 or 300%. I know this is not an ideal example, but it's a very strong and very simple example showing that deploying tendencies and being a little bit smarter about when you enter and when you exit can give you better performance, risk-adjusted performance, than holding just the index itself. And it doesn't need to be complicated. You just need to follow some built-in tendencies. Now, of course, we can work with this one. Okay, we can, as I said, what happens if we deploy the ADX on data 2 on daily? That will change as well. And again, I have no idea what will happen, but I assume we will reduce trade significantly, but we can have a look, or we can combine them. Well, that's less of a change than I expected. So we have 70,000. We increase the drawdown. We have still very high average trade, 112. So we can combine them. We can use both, right? Like we can use ADX. Again, this is a very universal tendency. The ADX, it works on indexes, period. So we can combine both. Let's see what happens. Right. So about 60, and the drawdown still about the same. So it doesn't really matter whether we pick ADX on main data or second data.
Yeah.
Yeah. So I think, and so the whole point was to show you that, you know, one common approach is like we can hold this index forever, and we can hope for 12% per year on average. But we also face a lot of risk, 25-30% drawdowns. Right now, year to date is about 25%. And we have to be in the market the whole time, which is also risky. Whereas if we take just simple tendencies and work them out a little bit with E-mini, we can potentially make more money with less risk. And I think that's the beauty of indexes, because you don't need to be super smart to beat indexes. This is not a strategy I would trade yet, because we can do much better, especially with breakout trading. But it is a strategy which I'm fairly convinced, if you run it live, long term you will do better than holding the index itself.
Yeah. Okay, so we've got quite a few comments and questions in the chat, so let's just go through them. First one is from Jace. With the set exit on close statement, does this work in non-simulated trading? I've never used it.
Yes, it does.
Yeah. Okay. And then Jace says, not too bad. Says he'll take it.
Good one, Rob. Yeah.
All right. So then we had some questions around date range, which I think you answered, didn't you? From 2007 to 20.
Yeah, 2007 here. From 2007 to until today, 1st of November. So it's today is the latest, the greatest. 2007, okay. I do, again, let me repeat, I do not use data before 2007 because these are not usually reliable. But of course, if you want to, we can change them here. Like we can start. I think the earliest we have for indexes in TradeStation is 2003, if I remember well. But I don't use anything before 2007, never. But we can try. Why not? Again, we're talking about tendencies. So pretty much, if you change anything here, a little bit here or there, the impact won't be that big. Yeah. So that's the difference. Not much of a difference, is it?
Yeah. All right. And then next one is Bill saying very good using only simple conditions.
No optimization. We have not optimized anything, not at all.
Yeah. So I got some people asking about, can you add this commissions and can you add those commissions? I think you addressed that, right? We've got to keep in mind this isn't a complete strategy. So it sounds like some of these people are, or some of these questions are trying to improve it. We're just looking at tendencies right now. Nate, what happens if you add to your current position at each negative quarter standard deviation breached? You would double in a year.
Yeah, you have to try. Why not? Yeah, potentially, yes.
Woohoo Beef Stews here. G'day Beef, good to see you here. Is this being tested over broker data or custom data like Dukas copy?
This is TradeStation data, continuous TradeStation data.
Yeah.
Continuous. Futures contracts.
Into the platform. Yeah. Would you say, sorry, this one's from Rock. Actually, I should be putting these on the screen. Let me, I forgot about that. So this one's from Rock. Would you say it makes more sense looking for long only indexes, long and short direction on indexes during a bear market?
Well, building strategies for bear market is a little bit different strategy. But one thing is still, one thing, there are two things that I still can guarantee. First of all, breakout trading does work for short trading on indexes as well. Second, if you use as your main filter market at the moving average 200 again, it will do the job as well. Just your sample size will be much lower.
Yeah. Okay, another question from Nate. Where is the position sizing? As you are making bank, you need to be adding micros.
We're just exploring tendencies. We're not building a complex strategy with position sizing, nothing like that. We're exploring tendencies. Yeah.
Okay. Thanks for that, Nate. And then a couple of
Can we get back to TradeStation? Because I want to show you something. Okay.
Go ahead.
I don't think I want to show, like, these tendencies are really, really robust. I just want you to understand, like, it looks like some of you are thinking already, like, building a proper strategy. That's not what I'm trying to explain. I'm just trying to explain that you don't need to almost break a strategy to beat the index. All you need to do is use tendencies which are already there, pre-built, and do exist. So, for example, one of the things these tendencies are so strong that you don't even, it doesn't almost matter what you change or how change it, you still get good results because that powerful the changes the tendencies are. So for example, for ADX, we can change, I often use period 20 and I use, don't laugh at me, but I use 17.5. Like that's, it's hard to explain why, but I use 17.5, right? I know it's a little bit weird number, but that's what I use. So I completely changed it, like ADX from 5, I went to 20, from 25 to 17.5. It almost doesn't matter. I can use any reasonable ADX tendency will do the job because the tendency itself is already very strong and powerful. See? That got even better, like 77,000, 12,000 drawdown. So it's very robust. Like that's the point. We have tendencies, and these tendencies are universal and strong. So we don't need to optimize and do much of a work to explain this. For example, we can change the fraction as well. Let's go, for example, go with 175. Again, you won't see much of a difference because the tendencies are there, and these tendencies are strong and powerful. And all you need to do is just take these tendencies. Now, the point is that if you take these tendencies as a very base and start building strategies on top of it, then you already combine pre-built edges, and you can use a pretty rock solid base. So you see, these tendencies are very powerful and very universal. Almost doesn't matter what you do, you still get positive result.
Yeah, very well explained. And so out of that, Rox asked a very good question. Rock's on fire today. Here we go. I don't know if you want to answer this one just yet. What other tendency filters do you think are worth investigating?
Okay, let's bring slides, Andrew, and I will tell you something, guys.
Okay, here we go.
So first of all, I showed you just a couple of simple tendencies. I will talk about other tendencies during this index month mastery. So don't forget to be on all the shows this month because I'll reveal more. Also, if you deploy a normal breakout trading approach, as I do, and as I share in my Breakout Trading Revolution book, you will learn a tremendous amount of things, how to do all this better. When it comes to tendencies, we would like to announce something as well. Andrew, we can get to the next slide, please.
Yeah. Here we go. It's coming up. Ding.
So we're announcing we will do an index mastery live workshop. And on this live workshop, I'm going to present all the tendencies you need to know to really squeeze every penny or every tens of thousands of dollars from indexes. So if anyone is interested in learning all the tendencies, all the strong biases, and there are quite a few of them, and some are extremely powerful, then go to gobta.com/indexes, and that's where you can learn even more than what I shared today. So that's it.
If I can just comment about that URL, that's the wrong one. We're going to have to fix that. So what should happen is when you go to this URL, which will be fixed just after this show, there'll be a page where you can download all the, what do we call it? The summary notes from these shows, this one, and then we'll be doing 5 weekly shows in a row. So we're going to combine all this information into little summary PDFs, and we'll send it to you. So you can go to that page and submit your email address, and we'll send them to you automatically. And then also when the Index Mastery Workshop is released for enrollment, then we'll let you know then as well. So, but don't go there right now. Give us like 20 minutes and we'll get it fixed because it's going to the wrong page.
Okay, so 20 more minutes.
Yeah, yes. All right, thank you, Thomas. We've got a couple more questions in the chat, actually, if you want to address those. One moment. Here we go. Here's one from HUDs or Who's. How do you know about slippage in any given market?
Well, it's easy. So E-mini S&P is super liquid. So slippage just almost none, or just if you work with one tick round turn, that's enough. That's good, because it's an extremely liquid market.
Okay.
And I know from experience, from real life trading experience.
Yep. Okay. And then this is an interesting. The screen here we go. We're having an issue with this thing coming. Here we go. Finally, the tendency is about 8% drift to the upside for ES.
Not sure what it means, but
so I think the first slides you showed, there was coming to the numbers now was like 11% over 10 years and 15%
okay.
over longer from memory.
Okay, got it.
And,
Got you.
and so it's got 8% drift, but that what you showed really kind of I guess enhances the idea that these tendencies. I mean, you showed something that gave us more than 8% a year, right? So, I guess it just reinforces the idea of these simple tendencies that you're talking about here. So
yeah, cool. Yes,
I'm having an issue with my screen at the moment. I don't know. Here we go. I'm still trying to get this message on the screen. And then a question from Hutz Huz. How about slippage for non-index markets?
So what is the question?
So the first question was, how do you know how much slippage you use in a given market? And then the second part, slippage for non-index markets. You go about determining what's realistic.
Well, again, I go from my experience, but if you want universal rule, just take one tick on entry and one tick on exit, and in most cases you will be safe. Some markets get a little bit better, some a little bit worse. In general, it fluctuates, but it's a pretty safe start point. It's a good way to start with one tick at the entry, one tick at the exit.
All right, that looks like that's all the questions and comments in the what do you call it, the chat. So thank you very much. Thomas, do you want to kind of give us a quick 30-second summary on everything you've shared today? Because you've shared some really interesting points. I think it might be good just to summarize it. So.
Right. So guys, the beauty of index trading is that index markets, they have built-in tendencies which you cannot find in other markets, or it's very hard to find them. But it's easy not only to find them in indexes, but to really deploy them profitably in your trading, to explore them and to use them. And that's the beauty. That's why I like. That's what I really like about index trading. So you don't need much. You need a simple breakout formula, which again you can get in the Breakout Revolution book, the Mr. Breakouts formula. You need pre-built biases, which are pretty much defined by the industry as moving average 200 and long-term bias, confirmed short-term, long-term on E-mini S&P. You need to understand that indexes have great performance from Monday to Friday. So and it's much safer to close the position over the weekend. And you need to understand that ADX works extremely well on indexes. If you use this knowledge alone should already give you more than enough to build absolutely fantastic, profitable, long-term profitable, robust strategies on index markets.
Yeah, that's an excellent summary. Thank you, Thomas. I just want to squeeze in one more question here before we start wrapping. So this one's from Mark. There, Mark. I'm interested to hear what Thomas would say to this one. Why do you suppose markets have very different characteristics to the long versus short side? I mean, besides the long-short biases. So why do you think this behavior is actually there?
Why do you suppose, or why do you think it is there? So I don't suppose that. It's just based on statistics. If you take daily data of indexes, it's so obvious from, if you do the distribution and if you dig deeper into numbers, I do not suppose that, just obvious from numbers. Why it is so, that would be, I don't know. I can have a lot of opinions on that, but it's just guessing. Like, it's my private opinion. The truth is, I have no idea already. I really don't know. I have no idea, and I don't care much why it is. I more care what is the stable tendency and how I can make money on it. I never care that much why it is. It just is guessing. I don't know. I honestly don't know.
It is what it is, right?
Yeah, exactly. It is what it is. Let's see if we can make some money on it.
Yeah. And Nate's got a comment here. Let me see if I can get this. Okay, we're back. You're bang on. There are tendencies to be taken advantage of with indexes. Well done. Thanks, Nate.
Thank you.
And Nate's had some good questions today as well. One quick question from Huds, and then we'll finish up here. So, index mastery, is it for non-masterclass students? Is a benefit for masterclass students to attend?
Absolutely, yes. It's for everyone. Doesn't matter if you have or don't have the masterclass. It's for everyone. I'll show you a lot of very cool stuff with exact guidance how to use them to create very neat index strategies.
Yep.
Doesn't matter whether you will use masterclass or not. It's universal. It's general.
Yeah. All right. Well, thanks for sharing that today, Thomas. Now, we just want to make sure that everyone realizes that this Index Mastery Month, we're going to be doing a show every single week now. So typically we do every 2 weeks, and we don't want people to miss the next one. Can you give us any clues about what the next one is, Thomas?
To be honest, I don't remember, because we planned so many of them, and I'm now I don't remember. I can just tell you we have 4 more. All of them will be awesome. We will cover as neat stuff as we covered today. We will be practical. We will show you numbers, research, not any kind of fluff, but real stuff like we did today. And there's a lot to cover, and even more to cover in the Index Mastery workshop. So it will be a busy month, and you will learn even more about indexes.
Yep, absolutely. So I hope to see you again same time next week. Same place, same time,
thumb
same
up,
place.
please, if you like this show.
Yes.
And please subscribe if you don't want to miss the following episodes. It will be worth it. Subscribe to our channel so you can watch the entire Index Mastery Month here on YouTube. And I hope you liked it, guys. I hope you learned something and you liked today's episode.
Exactly. So thanks for joining us today, and we'll see you again next week. And happy trading.
Happy trading. Thank you. Bye, guys.